Well, after trying to rally yesterday on Thursday, the markets went down again. The Dow was down another 545 points after being down 831. That's almost 1,400 points in 2 days. Now, like I said yesterday, this so far has been like the mini crash we had from late January into early February at the beginning of 2018. Sharp, but contained to about 10%. Well, I tell you, we've been monitoring this S&P 500 channel for our scenario 1 and 2. And as long as it stays roughly in that channel, the trend is still intact. And guess where it went yesterday and closed right on that channel on mini markets. The Russell 2000, the NASDAQ, and especially the S&P 500, which is the best one. So far, it has stayed contained. And again, I expected the bounce that's happening this morning. I'm recording this just pre-opening of the markets, but the futures are saying the Dow could be up near 400 points. Now, again, 400-point bounce versus a 1,400-point crash in just the last 2 days. That's not a giant bounce. So what we're going to have to see here, does the market bounce and hold this and come back towards the highs again, or does it turn around and break this channel again or break below the lows on Thursday? That's going to be the key test in the next few days, which we'll see. Now, another thing to note, China's market, the Shanghai Composite, did break an important line in the sand I've been talking about for a number of weeks now at 2640. It had that crash in late 2015 and had a very dead cat bounce. And then it has come back and tested those lows in that last crash, that last more violent crash. Well, it broke that yesterday. This morning, it's coming back a little bit, but it still has not broken above that. So that is the first danger sign. The second will be if we break to new lows in the coming days in markets like the S&P 500, the NASDAQ, and et cetera. Now, one other bad signal yesterday, unlike the February crash, the NASDAQ already broke below its 200-day moving average, which is a key momentum factor that traders watch. And the S&P 500 yesterday broke below that. So that's another warning signal. And finally, the commentary is like, okay, it's all about rising rates. And of course, we warned about this. We told you that the 30-year Treasury, if it went above 3.2%, it's gonna break up stronger, and it's probably gonna go to as high as 4.3%, and that's one of the biggest reasons that could contribute to this being the top here in late September, early October, instead of next year. But we still need to see bigger breaks down. But that's not the biggest reason, I think, for the last 2 days. In the last week, yes, the markets have started getting jittery and going down over interest rates rising, long-term rates, because that's bad for the markets, bad for real estate, everything. What I think's happened in the last 2 days, the markets are worried about China, and hence that China breaking that critical support. China's government days ago had to reduce its reserve requirements. That's monetary stimulus to try to encourage loans and lending because they're slowing down. This trade war is affecting them, and the markets are worried that this is a sign of weakness and that China is going to start slowing down. And of course, the world doesn't need that. The Chinese stock market's already down 29%. Emerging markets are down 26%. This is the biggest obvious divergence against the U.S. and developed country markets. And on top of that, the U.S. markets are the only ones making new highs globally in the developed world. And the small caps, since late August, have finally been underperforming the large caps. It's another potential sign, classic sign of a top. So we're still on alert. We have not broken to dangerous levels yet. The first sign will be a break below 2,700 in the S&P 500, a clear break, but it's going to take more even. But that would start to tip the scales towards, maybe this was a top. We're hoping it is. We always think sooner we can get this over with, the better, and start booming again. So again, we'll keep you updated.